on top there. There we go. Hey, everybody, it's Jen Duplessis. Welcome back to Mortgage Lending Mastery Beyond the Podcast. Beyond the Podcast. So what we'd like to do at Beyond the Podcast is just go back to some of our guests from previous podcasts. You know, we've been doing this podcast for 10 years now. And as a result of that, we have a lot of people that we want to find out, where are you now? What's going on? What's happening in your business? And with us today, we have Mikhail, right? How do you pronounce your last name, Michael? I should have asked you.
Mikhail.
Michael Mikhail. He is the CEO of Stratton Equities out of New York City and listed in Forbes in 2021. I thought I was going to add more of those, but what you really focus on is non-QM lending. And I wanted to talk about that today, because especially today. So welcome to Beyond the Podcast. And then we'll say hi first.
So we talk
welcome,
about
Michael. Yeah, just saying welcome. That's all.
Hello, everybody. Good morning.
Yeah. Okay. So let's talk about non-QM, with, and I play in this market as well, but what's happening, here's what I'm seeing what's happening is that standard financing is oversaturated. There's not enough market, there's not enough opportunities going on. I've talked to a lot of loan officers who have had what they call a goose egg month, where they've not funded any loans, first time in their career. God only knows what the feds are going to do when that time comes up, but what are you seeing on your side that might be different from when we first talked in 2021, right on the heels of that crazy massive year that everybody had with COVID? What are you seeing now?
Well, thankfully, it hasn't really changed much for us. It stayed very steady because we've been at this now for 6 years. And in the non-QM private money space, we are very well known throughout the country and, now throughout the world. We get a lot of foreign nationals from other countries that are reaching out to us. So for us, there was really no downturn, to be honest. I knew a long time ago this is the direction the market was going to go in. So that's why I kept at this. Stratton does offer more types of conventional loans as well. And we literally have that for our loan officers, right? Because a lot of loan officers are, I won't say scared, but don't know this industry. They don't know this market. They don't know how to handle such types of deals and loans. And we're very big in training, and we train them to do so. But it makes it easier to onboard quality loan officers, which we just onboarded a couple, once you have the ability to offer conventional Fannie Freddie Govy loans, so they feel like they're not stepping out of their own territory, and at least they can still do those. But there's no shortage in business on our end. There's a lot of articles that I know people have read that state that non-QM is going to be 25% of the business moving forward, and it probably even more so soon. Right now, we're looking at 1 in 4, 1 in 5 loans in the non-QM space. And it makes sense, right? I knew that 6 years ago, right? If you look at the stats, I've got the number, but a small amount of Americans can fit in conventional financing. So it makes sense that having more out-of-the-box financing is going to allow a wider demographic of people to qualify. Common sense, I would believe. But everybody pigeonholed themselves in the past X amount of years and the rate shops and the guaranteed rates and then all those, and we see where they all are today. I mean, we're growing exponentially. Our biggest issue is finding enough quality LOs to fill the amount of inbound business that we get. We can't keep up with the business. Literally can't keep up with it. Hundreds of leads a day coming in, and there's only so much that can be handled. And a lot of LOs in the space, and I talk very frankly, really didn't know what they were doing the past couple of years, because when rates are 2%, it's easy for anybody to get a loan and do a refi. You don't have to really work properly. People don't want to put in the time these days. So we're very picky on who we hire. We don't just hire some, I want to come in when I want to come in type of LOs. And they wonder why they haven't closed a loan since April. I'm like, how many hours are you putting in a day? What are you doing? Are you doing anything different? Right. You have to adapt with the market that we're in. right? So it's a lot more hard work these days than it was, let's say, 2 years ago when rates were in the twos. But yeah, no, we're doing phenomenal. Thank God. We built a new office in Parsippany, New Jersey, which is a very dense part of the country that has a lot of mortgage companies for the past 30 years.
Yeah.
We hired more underwriters, more processors, which are doing phenomenal. I have no complaints except trying to find more quality, real good LOs to really field the amount of business that we're getting. That's really it.
Yeah. So let's talk a little bit about, because, I have coaching clients that, I try to get everybody to say, look, if you're not going to go into, and I don't tell everybody, look, I'm a non-QM coach. I don't, definitely not that, but I do say, look, if you're a mortgage lender or real estate agent, one, for mortgage lenders, you should be doing non-QM because you're a mortgage lender. That means you do all mortgages. Same thing for a real estate agent. If you're a real estate agent, you should be doing all kinds of real estate, not just the condos for the first-time home buyer, because we have a lot of clients who are looking for fix and flips and build and rents and build and flips, whatever you want to call them. We see a lot of that in Texas. That's a lot of the business that we're doing right now. And because there's just nothing available. So the investors say, well, look, I'm just going to build it and then I'm going to rent it out. That's what I'm going to do. And that's, that development is really happening. We're seeing a lot of multifamily work. We're also seeing a lot of post-pandemic self-employed who couldn't qualify for the low interest rates, now being able to tap into their equity through non-QM. So there's a lot of opportunities out there. What do you think is driving, or I shouldn't say driving, what are you seeing coming your way? Let's not talk about loan officers, but about the client themselves. What is it the client is looking for? If you could break out maybe percentages of what you're seeing, is it fix and flips? Is it finally, as an owner occupied, I can get something? Is it most investor? What are you seeing mostly today? What's popular?
A lot of, in the past couple of years, millions of people have put themselves into bridge loans, especially when bridge loans were slightly lower rates than where they were now and a little easier to come across. And there were a lot more lenders in 2020, 2021, 2022 that were offering bridge loans. So a big thing is all those bridge loans that are coming due, right? Towards only 12, 24-month financing, they're all coming due. And I try to explain this to people, regardless where rates are, when a bridge loan is coming due, that borrower only has three options. Option A is to sell the property, and most people are not selling their property these days. Option B is to refi, either if they have enough equity to do a cash out term loan, which that's where the non-QMs and the DSCRs come into place, or if they don't, they're gonna get foreclosed upon. And a lot of the foreclosures that you're seeing these days are not actually from COVID. A lot of the foreclosures that you're seeing these days are from this situation. People that were in bridge financing are not able to get out of it for one reason or another. They damage their credit, they don't have enough equity, whatever the case may be. And now the lender, the current lender is not accepting their payments anymore. So your loan is due. It's 13 months, 24 months. Even though they're still making payments, the lender's going to cut that. You can't make payments anymore. Now you're in default. So that's a big thing that's happening. Another big thing that's happening on the foreclosures point, where people are not able to secure financing, is a lot of people that secure a property and the property's in good condition, the property doesn't needs updating. Instead of going and securing financing ahead of time when the property was not gutted, people go ahead and gut the property, which now it's worth
midterm. Interim financing.
It's worth $1 million when I bought it. Oh, now it's gutted down to studs. It's not worth $1 million anymore. You're lucky if it's worth 300 grand. So now they're trying to get more financing to finish the project. And we have some programs that might do that, but we don't want to get involved in that. Most lenders don't either. And that's another thing that people get stuck in, where they're not able to secure financing. Multifamilies, on the positive note, are strong. We're doing a lot of multis. We've always done a lot of multifamily. A lot of multis are strong. Small apartment buildings are strong. Really, it's the same stuff we've been seeing the past 6 years, to be honest with you. We've had no downturn.
Just a little shift. A little shift in some stuff. I love that you're saying about the bridge loans, because I was at the national, I don't know if it's the national, but the Lender Expo, the Private Money Lender Expo last year. And I was invited to come back and speak this year, and I had a conflict. But one of the things that, everybody was saying was, look, we're going to do extensions because we know the market's, tough, but now we're not doing extensions beyond the extensions. And so that's a really big issue, that we're going to see. And, I totally agree with you. That's going to be a big, big problem for all of us. So what do you see going forward? I mean, you're saying, look, I see more of the same thing. Is there anything that's rising, anything that's coming out of the woodwork, maybe crawling out of the ground? Are you seeing more construction? Are you seeing more collaboration with the investors that are coming to you? Are you seeing less credit score, even lower credit scores? What are you seeing as the future as we tie up our time together today?
Well, I mean, for me, I haven't sold myself in years, so I'm not the one that's fielding deals per se, right? So I see what's admitted into our pipeline, but I'm not. But again, we're on such a large volume that we intake that, it's hard to really give you that answer, because of how much volume we intake a day, a week, a month. I mean, there are days we get 470 leads in a day, so to field that in categories, we've always seen a lot of new construction. We actually don't do new construction. We don't do development. I think those loans take too long and have too low of a conversion rate of closing. So I don't want to time my LOs up on something that has a low conversion. DSCR, right? What I see is terminology, right? I see people that didn't know terminology 3 years ago. Now terminology comes out. Let's use DSCR as an example. And now people are asking for DSCR loans. That loan's been around for a long time. You just didn't know what it was called.
Oh, yeah.
Right. So now a lot of people pushing for DSCR, which has been around for a long time, as we all know. Fix and flips is a little less than I would say what it was a couple years ago. I'm not seeing maybe as much fix and flip, but not just that, not as many are getting approved these days that were getting approved, let's say 3 years ago. That's one thing that I can tell you. Couldn't tell you about the FICOs because, I mean, statistically, more Americans have a lower FICO than a higher FICO. That's a fact. So it's across the board. But yeah, it's been pretty, I mean, again, it's not much. I mean, and then we get the crazy stuff. Oh, I want to finance $1 billion marina in St. Bart's or something, right? We get those things all the time, which nobody's doing. But similar stuff. Listen, I'm happy with where the market's going. I can tell you that I thought when COVID hit, the market was in a tank. That was my professional opinion. I thought, and
I think you said that. I think we said that. We were concerned. Yeah.
Did say that, and it keeps and the listen. Big thing is because rates were so low a couple years ago, and people locked in. Your average American locked in at below 5%, and now housing is so high. Somebody really can't sell property A and really get much with property B, the next property, and then the rates are going to be wherever they're going to be. So people are staying in their spot. But that's on the like the conventional conforming refis are down 94% from 2001. 94%. Why is somebody gonna, unless somebody's in a dire need or family emergency, they're not gonna refi from 2 to 8%, or whatever the case may be. But in our world, dealing with investors and commercial and the niche that we're in, people never stop buying and refining because they're taking property A, leveraging it to go buy property B, C, and D. So they're making money with that money, right? So they're always in the market, regardless of where rates are. Plus, the property is cash flowing, right? When you have an owner-occupied or a second home, you're not getting income on that property. But when you have a multifamily or a 4 or 10 unit, yes, rates are going to go up a little bit, are going to minimize your cash flow, but the property is still getting cash flow. So you're not digging out of your pocket to pay for said property A or said property B. So people are a lot more inclined to do a loan because they're not paying for it.
Yeah, I totally agree. One last thing, I think we're going to have a little bit of a refi boom in the beginning of the year because we have the highest number of 401k applications. We have highest amount of outstanding debt. Average loan or average car loan is $1,000 a month. Credit card debt is at its highest in the trillions. And so everyone has used all their cash, all their credit card, right? Still have to make the car payment. And the only thing that they have is equity sitting in their house. They're going to give up their low interest rate loan, and they're going to sacrifice, because when that 401k liquidation or comes due and they have to pay penalties and taxes on it, there's nothing left. The well is dry. And so a lot of people are going to have to tap into their equity regardless. And I think that you're going to start seeing that. And that may either be refinances or spur on sale to clean the slate, start fresh. And if that happens, that'll be great for the investor world, because we'll have more rentals, because people won't be ready to buy again. So I think we're headed to something really cool, unfortunately, based on what's happened, over the last few years. But yeah, I've been telling everybody, get ready for when happens, because it's coming. It's definitely coming.
Something that hasn't been very prominent a couple years ago that is now is people trying to get seconds, right? A lot of people are trying to get seconds on their properties because, hey, I'm at a low rate, I don't want to lose it, so can you get a second? But they don't understand that seconds are generally harder to qualify if you're basing it on DTI. Not just that, the rates on seconds are very high. They're not 8 or 9%. They're generally double digits. So it doesn't really offset. It doesn't really make sense most times.
Yeah, absolutely. Absolutely. And he locks the whole thing. I mean, and people are capping them, they're shutting them down. So, and we have bank consolidation. I was just listening to Mr. Wonderful, Awesome, whatever, from the Shark Tank. I can never remember what his name is. And Mr. Wonderful, he said, look, we have 4,000 regional banks, and in the next year we'll be down to 2,000. So there's consolidation, which means there's a contraction in that kind of lending as well. So we're gonna, the well's dry. I would just say that's the theme. The well is dry, and the only opportunity is going to be to loosen up everything and to explore non-QM opportunities. If you have those life events, or if you are an investor, that's the best way to go. So, hey, thank you so much. It was so great catching back up with you again. It's good to see you. Thanks so much for coming back into Beyond the podcast. And I'm going to leave you with ask you to leave us with one thing, and that is a mantra, a quote, a thought, an idea. Leave us with something.
Well, talking about non-QM, I would say that don't be afraid of non-QM. It's a better option than traditional financing. So don't get scared of it. If you're a loan officer or a borrower, you should definitely look into it. You'll be surprised of how beneficial it could be.
Awesome. Wonderful. Thank you so much, Michael. Appreciate your time.